Chapter 5, Accounting Ratio and Analysis. Accounting ratio is one of the technique to evaluate the performance of company. Or you can say it is technique of financial statement analysis. Financial statement means profit and loss account and balance sheet for any company. So what is definition of accounting ratio? Relationship between two accounting figures expressed mathematically, either in forms of percentage or some absolute number in proportion, is known as financial ratios or accounting ratio. Accounting ratios help to summarize the large quantity of financial data and to make qualitative judgment about financial performance. Like rather than presenting all the details of profit, you can know the situation of profit by just profitability ratio. Okay, what is gross profit, what is net profit, what is sales, equity share, equity shareholders fund. So all these details can be expressed in form of accounting ratio, and financial performance of any entity, business enterprise can be known. In ratio analysis, comparison is done for useful interpretation of financial statement. You can compare performance of one firm of current year with the previous year, or you can compare the performance of one business enterprise with another business enterprise. So ratios are compared with any standard, then utility it is of utility of it is proved. These standard can be comparison with ratios calculated on the basis of past financial statement, comparison with ratio developed by business entity, comparison with ratio of industry કે overall industry માં કેવું performance છે અને તમારું performance કેવું છે, and comparison with ratio of competitors performance ratio. Now, what are the objectives or purpose of ratio analysis? For financial statement analysis, only accounting statistic information is available from detailed disclosed in financial statement. These figures do not represent any analysis. It does not give you any insight, any judgment, any decision whether it is to be improved or whether the situation is good or bad. So it is not an indicator. But ratio analysis works as an indicator to the parties who are using financial statement. Different stakeholders like owner, shareholder, employees, customer, bankers, creditors, government, investors undertake analysis of profit and loss account and balance sheet for their own purpose. So to make this analysis meaningful and useful, ratio analysis is used. Then you can present all the accounting information which is very complicated or in detailed form in a very simple and lucid manner. Okay, rather than giving all the details about company's profitability, solvency, financial situation, you can present the whole information in one figure by ratio analysis. By calculating profitability ratio, you can know about the profitability status of the business. By calculating liquidity ratio, you can know about the liquidity position of the business. You can know about the long-term solvency, that is financial liability, financial strength, economic status of the business. To know the operating efficiency, whether the business is being operated efficiently or not, or whether the managers are proved inefficient or not. Then for forecasting, for making prediction, by observing the trends represented by ratio, you can forecast the future. The information about weak aspect. The ratio will give you insight regarding profitability, liquidity, solvency, efficiency, performance. So which is the strength and which is the weakness for any business, and how to overcome this weakness, that can be known with the help of ratio. Then interfirm and intra-firm comparison. The comparison of operating performance of business entity with other business entity is known as interfirm. એક કંપની બીજી કંપની જોડે અને સેમ કંપનીનું એના past year ના data જોડે comparison કરો, that is called intra-firm comparison. That can be done with the help of accounting ratio. Now the limitation. So it is dependent on financial statement result. So if information contained in balance sheet and profit and loss account are false or incorrect, the accounting ratio will not prove to be useful, because it will also produce misleading result, because it is based on miscalculation. Then absence of standard ratio. There is no standard ratio for each and every business. What is good for one type of company may not be good for another type of company or another type of industry. Influence of price change. The base of ratio analysis is financial statement. Financial statements are prepared on the basis of historical information. It does not account for inflation or price rise. So accounting ratio will also suffer from this limitation. Then avoidance of qualitative aspect. Qualitative aspect which will affect the operating efficiency of business, like loyalty, honesty of employee, will not be considered while calculating accounting ratio. Sometimes it will be difficult to make comparison between two firms. Why? The use of different method like depreciation and valuation of business, the valuation by two business entity. Okay, one company is providing depreciation as per straight line, other company is providing depreciation at written down value method. So accordingly, there will be fluctuation in profit as shown by different business entities. Now, presentation of ratio. Ratio can be presented in terms of proportion, is to form. Then in terms of percentage, when it is multiplied by 100. In terms of times, that is turnover. Or in absolute form, or in terms of fraction. In terms of days, weeks and months. Now, ratio can be classified as per traditional method and as per functional classification. Computation of accounting ratio is done on the basis of financial statement. In this statement, trading account, profit and loss account and balance sheet are included. Okay, ratio prepared on the basis of trading or P&L account, ratio prepared on the basis of balance sheet, or composite ratio, which are prepared on the basis of information of trading or P&L as well as balance sheet. Then functional classification. To measure financial health or to acquire information about different aspects of accounting of business entity, ratio analysis is used. These aspects include profitability, liquidity, solvency and efficiency. So profitability ratio, liquidity ratio, solvency ratio and efficiency ratio. These four types of accounting ratio are in your syllabus. Now see, profitability ratio. The main objective of every business is to earn profit. The earning capacity of the company is known as profitability. There are different ratios to measure profitability. तुम्हारे 4 ratios are in your syllabus as per profitability. Gross profit ratio, operating ratio, operating profit ratio and net profit ratio. Gross profit ratio discloses the relation between gross profit and total net sales. Now see. The formula for gross profit ratio is gross profit upon total net sales. Now gross profit means total net sales. Net sales means sales minus sales return. Minus cost of goods sold. Now what is cost of goods sold? So cost of goods sold means opening stock plus purchase expense minus closing stock plus wages and plus factory expense. Okay, this is your cost of goods sold, COGS. Opening stock plus purchase expense minus closing stock plus wages plus factory expense. If there is no detailed explanation, then we will not consider purchase expense, wages and factory expense. Simply cost of goods sold means opening stock plus purchase minus closing stock. But whenever information regarding purchase expense, wages and factory expense are given, it will be added. So that will give you cost of goods sold. So to arrive at gross profit, you have to subtract cost of goods sold from net sales. And then you can obtain gross profit ratio. Gross profit upon total net sales into 100. Now gross profitability of the business can be measured through gross profit ratio. Its trend, it is income based ratio. Thus its increasing trend indicate enhancement of profitability. Means higher gross profit ratio means higher profitability, higher income, and lower gross profit ratio means lower profitability. Okay, so it's formula. Whenever you have to remember formula, this the whole chapter is based on formula. So total all in all there are 14 different ratio, and for that 14 different formulas are there. Out of that they will ask 3 to 4 ratios in your paper. Now then operating ratio. Operating ratio discloses the relation of operating cost and sales. Now what is operating cost? So operating cost means cost of goods sold plus operating expense. The expense which are needed to operate or to run the business. So operating expense includes administrative expense, sales and distribution expense, or you can say selling expense, marketing expense, employee benefit expense, depreciation, and amount return of that is amortization. So all these are included in operating expense. So operating cost means cost of goods sold plus operating expense, where operating expenses include office expense, administrative expense, sales expense, marketing expense, employee benefit expense, depreciation and amortization. Non-operating income like interest received, dividend received, profit on sale of asset are not considered while determining operating cost. Interest paid and loss on sale of asset are also not considered, because whatever interest you are paying is a part of financial cost, not operating cost. See, formula: operating ratio is equal to cost of goods sold plus operating expense upon net sales into 100. बराबर. अब हम trend. The decreasing trend of these ratios is favorable. Means lower the ratio, good is the profitability, and higher the ratio means less profitability. This is reverse, decreasing, because it represent operating cost in the form of percentage as part of total sales. So if operating cost is higher, your profitability will be lower, and if operating cost is lower, your profitability will be higher. Then operating profit ratio. Operating profit means sales minus operating cost. So sales minus cost of goods sold minus operating expense, that will give you operating profit. Operating cost means cost of goods sold and operating expense upon net. Barabar? So whenever out of total sales you are subtracting operating cost, that is cost of goods sold and operating expense, it will give you operating profit. So formula for operating profit ratio is equal to operating profit upon net sales into 100. Trend, this income is based on income, so increasing trend. Higher the ratio, higher profitability. Then net profit ratio. These ratio displays the relationship between net profit and sales. This is an income based ratio. This ratio shows the percentage of net profit. Now what is net profit? Just like we have found out by preparing profit and loss account in final account. Sales minus sales return, net sales, non-operating income, that is total income, less cost of goods sold, that operating expense, financial expense, non-operating expense, that will give you profit before tax, minus tax, that will give you profit after tax. So net profit ratio is equal to net profit after tax upon net sales into 100. What is the objective? The overall profitability of the business can be known with the help of this ratio. This is the income based ratio. So increasing trend of it indicates enhancement of total profitability. Okay. Now, liquidity ratio. Every business is having main objective to earn profit. The credit worthiness of business provides fuel to earning capacity. So it is very important to maintain liquidity. Liquidity means the firm must be able to pay its regular expense, regular bill, regular dues on time. Sometime it may happen. We may have invested our fund in fixed asset, long-term asset. So we will face financial liquidity crisis. We are having wealth, but we are not having enough money so that we can pay our short-term liability. So this short-term solvency or short-term financial viability of business is known as liquidity. Liquidity means ability of the business to pay its short-term liability. Short-term liability means current liability. There are two ratios, current ratio and liquid ratio. Current ratio shows relation between current assets and current liability. So formula is current asset upon current liability. So what is the proportion of current asset in comparison of current liability? In comparison to current liability, how much time higher the current asset is? That can be known with the help of this ratio. Now, current asset will include cash, cash equivalent, short-term investment or current investment, stock, trade receivable, short-term loans and advances, income outstanding, taxes paid. Final account matung tomorrow, current asset, A, B, C, D, E, F. So all these are part of current assets. While current liabilities means creditors, bills payable, outstanding expense, liability due but not paid, unpaid expense, income received in advance. So all short-term provision, bank overdraft, all these are part of current liability. The objective of this ratio is to know the capacity of business to pay short-term obligation. The proportion of this ratio varies industry to industry. Generally 2:1 is considered to be ideal. Means your current asset must be double than your current liability. So current ratio is equal to current asset upon current liability. And current asset minus current liability means your working capital. Then liquid ratio. The liquid ratio shows the relation between liquid assets and current liability. These ratio indicate proportion of liquid asset. Liquid asset means from current asset, stock and prepaid expense are subtracted. That will give you total liquid asset, which can be easily transformed into cash. Liquid asset means asset which can be easily converted into cash. So liquid ratio is equal to liquid asset upon current liability, where liquid asset is equal to current asset minus stock minus expense paid in advance or prepaid expense. Increase in current asset will lead to increase in current ratio. Decrease in current asset will lead to decrease in current ratio because it will affect the numerator. While increase in current liability means decrease in current ratio, and decrease in current liability means increase in current ratio. Same way, increase in liquid asset, increase in liquid ratio, decrease in liquid asset, decrease in liquid ratio. Increase in current liability, decrease in liquid ratio, and decrease in current liability means increase in liquid ratio. Then solvency ratio. Economic or financial solvency of business is very important. So long-term solvency, financial strength, economic status, economic viability, economic health, whatever name you say. These type of ratios are used to measure how far business is viable, competent to go in long term, to pay long term liability. So debt to equity ratio, total assets to debt ratio, proprietary ratio, and interest coverage ratio. Debt to equity ratio shows the relationship between debt and equity. So out of your total capital, how much money you have arranged from owner's fund and how much money you have borrowed. So what is proportion of shareholders fund and what is proportion of long-term liability or non-current liability. So formula debt, that means long-term or non-current liability, means long-term borrowing, long-term provision, other long-term liability upon equity shareholders fund. So equity shareholders fund means equity share capital plus preference share capital and reserve and surplus. And if there is debit balance of profit and loss account, it will be subtracted. The reserve and surplus account minus the loss. The objective of these ratio is to know the proportion of owner's capital and borrowed fund, which are acquired by business as a long-term source of finance. There is no standard measure for this ratio. What is good for one industry may be worse for another industry. So if this ratio is higher, it indicates the business unit is more dependent on borrowed fund. Means out of your total capital, you have borrowed too much money outside the business. Sometimes it is good, sometimes it is bad for the business, depending upon the overall market situation, industry, economic condition. So all the other factor will be decisive factor. Then total assets to debt ratio. Total asset to debt ratio is equal to total asset upon long term liability. Total asset means non-current asset and current asset, asset side to total. Remember? And long term liability or non-current liability means long term borrowing, other long term liability and long term provision. The objective, it can be ascertained that out of total asset, what proportion of total asset is acquired through non-current liability. Means whatever investment we have made in total asset, out of that, how much we have invested by borrowing from outside the business. How much fund has been invested into the business by borrowing from third party. Here also there is no standard measure. The ratio indicates reverse trend to trend of debt equity. Generally when this ratio is higher, it is less risky to lenders to lend for their fund. And if this ratio is lower, it is more risky to lend fund to such type of business. Then proprietary ratio. Proprietary means ownership. Ownership or proprietary ratio shows the relation between total asset and owner's fund. Now there are two approaches to determine owner's fund: liability and asset. So according to liability approach, owner's fund means equity share, preference share and reserve and surplus. As per asset approach, non-current asset plus current asset minus non-current liability and current liability. So either you will subtract non-current and current liability from total asset, that will give you owner's fund, or you will simply add equity, preference and reserve to arrive at owner's fund or proprietor's fund. So whatever information is given in the sum, on that basis you have to find out owner's fund. Formula for proprietary ratio is owner's fund upon total asset. Then interest coverage ratio. These ratio shows relation between earning before interest and tax and interest on long-term debt. Whether your earning is sufficient to pay interest, whatever interest you are paying on borrowed fund, like interest on loan, interest on debenture. So whether your profit is sufficient, how much times your profit is higher than whatever interest you are paying. So formula is earning before interest and tax, or you can say profit before interest and tax. So profit before tax, in that you have to add interest paid, and if profit after tax is given, you have to add back tax as well as interest. We are concerned with profit before making payment of interest and tax. So interest coverage ratio is earning before interest and tax, or profit before interest and tax upon interest on long-term debt. Long-term debt means debenture, bank loan, loan from financial institution, long-term public deposit, all that. Objectives. There are two ways to provide capital. Capital provided by owner and capital borrowed from outside. No interest is paid on owner's capital because dividend is not compulsory. Dividend is just distribution of profit after anything remains from paying to debenture holders and loan holders. So before lending fund to business, the lender who is going to give money surely will examine interest paying capacity. Whenever we will go to bank and will ask for loan, bank will first of all see whether I will be able to pay interest, whether I will be able to pay EMI. If my income is 50,000, how can I afford to pay EMI of 60,000? So on the basis of my financial capacity, my financial result, my financial earning, my profit, the lender will lend money to me. Bank will give loan to me. So to examine the status of interest payment capacity, this ratio is used. This ratio indicates the interest payment capacity of the business. Thus, higher ratio means higher interest payment capacity of the business. Then efficiency ratio, or you can say activity ratio, or you can say turnover ratio. First, stock turnover ratio, or material turnover ratio, or inventory turnover ratio, one and the same thing. These ratio shows the relation between cost of goods sold and average stock. How many times stock is converted into production and sales? So how speedy your operating cycle is, starting from acquiring raw material till selling the goods. How much time it is required? That is called stock turnover. How fast the stock is circulating in your business. Like for FMCG company, fast moving consumer goods, groceries, day-to-day items, for that stock turnover ratio is going to be very high. For any business enterprise which is dealing in high-end equipment, machinery, for that stock turnover ratio is going to be very low, because it is not possible to sell numerous machinery or equipment every day, because it will take time to manufacture it and to sell it. જે કંપની ગ્રોસરી કે એફએમસીજી પ્રોડક્ટ બનાવે તેનો સ્ટોક ટર્નઓવર રેશિયો હાઈ હોય, પણ કોઈ ઇન્ફ્રાસ્ટ્રક્ચર કંપની હોય જેમ કે મેટ્રો રેલ બનાવે તો રોજે રોજ થોડી બને, it will take years and years. So for that stock turnover ratio is going to be very low. So cost of goods sold, as we discussed earlier, opening stock plus purchase expense minus closing stock plus wages plus factory expense. And average stock means opening stock plus closing stock divided by 2. Accounts માં average કીધું એટલે opening plus closing divided by 2. બરાબર? Average inventory plus closing inventory, average inventory is equal to opening inventory plus closing inventory divided by 2. Gross profit is equal to sales minus COGS. So you can use this formula also. COGS is equal to sales minus GP, depending upon the information provided. This ratio is the measurement of efficiency of conversion of stock into sales. How efficiently you are converting stock into sales, how fast your production and operating cycle is. Generally, increasing trend is acceptable. Increasing trend shows very often stock is converted into cost of goods and finally into sales. So your sales procedure is very fast. So it is established that higher ratio, higher sales, higher profit. Then working capital turnover ratio. These ratios show the relationship between sales and working capital. Or when sales is not given, you can use cost of goods sold. Okay, when it is not given in the sum or when it is not possible to find out sales, you have to use cost of goods sold upon working capital. Working capital means current asset minus current liability. The purpose of this ratio is to know the proportion between sales and working capital. The purpose to invest in working capital is to yield revenue. Whatever investment we are making in current asset is for generating regular source of income. This ratio is used to examine the efficiency of working capital. How efficiently we are using this working capital, this current asset, current liability into the business to increase our sales, increase our turnover. Increasing trend is favorable. The increasing trend shows efficient use of working capital, which is the cause for higher sales and higher profit. Then debtors turnover ratio or customer turnover ratio or debtors ratio. Debtors turnover ratio is equal to credit sales upon average trade receivables. Average trade receivable means opening trade receivable plus closing trade receivable divided by 2. And a trade receivable means debtors plus bills payable. The opening balance of debtors and bills receivable, closing balance of debtors and bills receivable divided by 2. That will give you average trade receivable. Whenever there is separate information regarding credit sales and cash sales, you should consider credit sales. And when no information is given, you should consider total sales. Here we will assume that all sales is on the basis of credit. See, during determination of trade receivable, bad debt reserve should not be deducted from debtors. These ratios for collection period for not receivable amount. Objective. From these ratio, it can be ascertained that how many times debtors and bills receivable are emerged due to credit sales. This will show how fast you are collecting money. Whether your credit policy is too lenient or too stringent. Higher debtors turnover ratio shows how quickly the collection is converted into cash. Whenever you are selling goods on credit, in how much time you are recovering the money. On the basis of that, you can decide your credit policy, whether to give more credit, less credit, or to sell on cash or credit. Then this is performance ratio. Higher ratio shows higher collection efficiency and lower investment in debtors and bills receivable, while lower ratio indicates low collection efficiency and high investment in debtors and collection. Means your outstanding amount or receivable amount is higher, but you are very slow in collecting money. તમારે બહુ બધી જગ્યાએથી પૈસા લેવાના છે પણ પૈસા આવતા નથી, which will create liquidity problem, liquidity crisis if proper action will not be taken. Then from that you can calculate collection period. In how many months money is collected. So collection period in months means 12 upon debtors turnover ratio. If it is in days, then 365 upon debtors turnover ratio. And if it is in weeks, 52 upon debtors turnover ratio. Okay. Whether it is month, week or days, that will be clarified in your sum. Then creditors turnover ratio or creditors velocity. So here credit purchase instead of credit sales and trade payables instead of trade receivable. So Creditors turnover ratio means credit purchase upon average trade payables. Means opening trade payables plus closing trade payables divided by 2. Now trade payables means creditors plus bills paid. From these ratio it can be known that how many times creditors and bills payable are earned due to credit purchase, or in how many days we will have to make payment. What is the period of credit allowed by creditors or supplier to us, or whenever we are selling goods on credit, in how much time or in how many days we will have to make payment. This is performance ratio. Lower ratio shows higher payment efficiency, means you are paying very speedily. So owner has to spare his own capital. Whenever you are making payment speedily, but you are not able to collect the money, it will create liquidity crisis. And whenever you are not making payment on time, it will deteriorate your prestige or creditability in market. કે ભાઈ આ તો payment આપતા જ નથી, પૈસા આપતા જ નથી. Now average payment period or payment period can be determined by this ratio. Payment period in months, so 12 divided by creditors turnover ratio. Payment period in weeks, so 52 divided by creditors turnover ratio. And payment period in days, so 365 divided by creditors turnover ratio.